What if I don't pay all my planned intended premiums into an IUL policy, Index Universal Life? You're going to be blown away in this episode when I show you that if you're max funding the policy and you even put in one annual max funded premium, and all of a sudden something happened, you lost your job or something, you got disabled, you could probably coast 10 years without paying another dime before you would maybe need to nurture it with a small premium payment. So I'm Doug Andrew. What do I know? Well, I've been helping people in America now for 5 decades optimize their assets and minimize taxes. My favorite financial vehicle, without question, is a property structured max funded IUL. Okay. If you want to accumulate your money tax-free and access that money tax-free, knock the socks off of putting money into traditional IRAs or 401ks invested into a volatile stock market, you'll end up with probably double to quadruple the net spendable income out of a property structured max funded IUL versus IRAs and 401ks. You can check out various episodes on this channel to see why and see the proof. Okay. But when people see IUL, then they get worried because they're so used to these rigid other policies or contracts where you're stuck. Okay, I like IUL because it's flexible. If you've ever heard one of my beatitudes, blessed are the flexible, for they shall not be bent out of shape. Yeah, I want to be flexible. Life happens. Okay, so let me explain this here. When we talk about planned premiums, let's make sure we're on the same page here. Planned premiums means that when you take out an insurance policy, like an IUL policy, the insurance company wants to see an illustration of what your intended planned payments are going to be. That's called a planned premium, what you plan on paying in premiums, because they're going to issue the policy with that hypothetical. If you pay the premiums that you say you're planning on paying into this and the times you're going to do it, here is what's going to happen to the policy. Okay. So those are called planned premiums. It could be $500 a month, $1,000 a month. It could be $10,000 a year, $100,000 a year into the policy. That's called a planned premium. Now, are you obligated, once that policy is issued, to pay that planned premium? No. That's your planned premium. You're intending to do that. You're not obligated to do that. In fact, if you're max funding the policy, you've got all kinds of, elbow room or flexibility. So let's talk about, again, objectives here. Whenever I ask people, so what's your objective to take out an IUL? And they go, well, I've been watching videos and I want to use it for living benefits. Yeah, I want to have the highest net spendable retirement income. Okay. Then max funded IUL property structured is the dream solution because it will eliminate the 3 dangers that cause most retirees to outlive their money: taxes, inflation, and market volatility. Okay. We do that by converting to tax-free life insurance. Now you don't have to worry about taxes going up. If you understand linking to the things out there that are inflating, I don't like inflation any more than anybody, but it doesn't hurt me because it actually benefits me. I earn a rate of return equal to or greater than the inflation rate. I've always outpaced inflation. And then by using indexing, I get to participate if the market goes up, but I don't lose when the market goes down because my money's not in the market. Okay. Now, the 3 greatest benefits or strengths of IUL is liquidity, the ability to access my money when I need it, safety of principal so that the money I set aside is not going to be lost due to market volatility or downturns in the market, but in a year that I make money, that becomes newly protected principal. I don't want to lose money in future years that I made in previous years. Most financial vehicles can't do that. And then I want to earn a predictable rate of return, tax-free. When I say predictable, I'm not talking about pie in the sky rates of return, even though with property structured IUL, when you understand diversification and rebalancing, our clients have some years where they get credited 25%, 61%, 158%. But those years just come and go. They happen usually every 3-7 years or so. But the average return between the ups and downs is usually between 11 and 14% if you rebalance, have annual reviews, okay? If you don't have an IUL professional doing annual reviews, you might be lucky to earn 8 and maybe net cash on cash 3 or 4. If it's structured correctly and funded properly and you rebalance every year, you can earn more like 11 and net 10, okay? So that the cost of insurance is only going up 1%. And so that's the key. And so when we address this question, what if I don't pay my plan premiums like I intended? Okay. Well, after you've structured it, let's say with an example here, you're a male age 60. And it doesn't matter if you're 35 and you're designing it to accommodate $500 a month or whatever. If you're taking the least death benefit under TEFRA and DEFRA tax citations, which is the objective, a male age 60 wanting to reposition $500,000 to increase the liquidity, safety, and rate of return, I go in there under TEFRA and DEFRA and I say, what's the least amount of insurance I can get away with under TEFRA and DEFRA? And it's going to be about double that amount, about $1 million. Now, I could buy way more insurance than that for $500,000. That's not the objective. Number 2, I want the cost of that insurance to get cheaper as I get older. I want the spigot on the bucket, the cost of the insurance to get smaller as you get older. So I am going to choose the level death benefit option because I don't care about the death benefit. I'm not doing it for that. I want the best rate of return. I want the insurance cost to get cheaper as I get older. So I want my cash value to be part of the death benefit so the net amount at risk gets less to where eventually my money will grow to equal and exceed the death benefit so that the actual cost of insurance is zippo or very, very, very minuscule, okay? A lot of agents don't understand this concept. So I'll simplify it here. If I'm a male age 60 and I want to comply with TAMRA tax citation, maybe I can only fund this $100,000 to $125,000 the first year. The first day of the second year, I can put another 100 or 125 grand in. And then another, and in 4 years and 1 day, I've got my 500,000 in there. Many times in 3 years and 1 day, I'm max funded. What did that do? By complying with TAMRA, by spreading out the funding, now I'm grandfathered that all my money is not only growing tax-free, but if I have $500,000 in there, I could generate $50,000 a year of tax-free income at age 65 to age 120 without depleting principal. If I'm not ready to retire, that $500,000 based on even a 9.6% average rate of return that I've had since 1980, 9.6 into the rule of 72 means my money's going to double every 7.5 years. So if I have $500,000 in there in 4 years and it doubles to $1 million in another 7.5 years, in 11.5 years, my cash has grown to equal the death benefit. I'm self-insured. The cost of insurance is zippo. Now, truth be known, if I happen to die that year, the insurance company is going to pay out $1,050,000, 5% more than the death benefit. The cost for $50,000 of insurance is minuscule compared to the interest I'm earning on my $1 million, okay? This keeps it tax-free under TEFRA and DEFRA. $1 million can generate $100,000 a year of tax-free income now without depleting principal. But if I'm not ready to retire, my $1 million in another 7.5 years doubles to $2 million. $2 million can generate $200,000 a year of tax-free income. But at that point, if I happen to die, the insurance company pays out $2.1 million. They're only charging me for $100,000 of net amount at risk because the interest on $2 million is way more than that cost. But the insurance is getting cheaper as I get older. So what does that mean? Okay, it means this. If your objective is living benefits, the older you get, the cheaper the insurance becomes. So maybe 20 years down the road, I have $2 million in there. If I earned 11% that year, I would probably net that year 10.9 cash on cash. Retroactive back to the very first day when I was taking my 4 years to fill it up, retroactive back to day one, I would have earned 10% tax-free in order to have $2 million. I earned 11, I netted 10. Now, show me anything else that does that. Most other policies, whole life, you're not going to earn 10, you might earn 8, but you only net 5.9, okay? The cost of insurance just is double. But if you didn't max fund it, if you didn't pay all your planned premiums, what happens? Okay, so here we go. If I paid 100 or 125,000 of the 500,000 in year one, and all of a sudden something happens to me, I get disabled, I lose my job, I get set back. Am I obligated to pay the second year and the next 100 or 125,000? No. Do you know that 125,000 will cover the spigot, the cost of insurance, which is like way less than 1/10 that, for 10 years? I wouldn't have to pay another dime into this policy for 10 years. I can coast. Whole life won't let you do that. And so this is so flexible. Now, am I obligated to ever pay any more money into it? No, but it would behoove you then to lower down the death benefit so that you have some insurance for the rest of your life, but you lower the cost of the insurance because you're taking the insurance down to 200,000 because you only funded it 20% of the way, or maybe 25. Maybe you lower down the death benefit to 250, and now it's max funded. Does that make sense? It's very flexible. Let's say you put in 3 years. 125, 250, and then on top of 250, you have 375,000. Now you're 75% funded of the 500 grand. And all of a sudden something happens. Now, you're 75% funded. You could coast for years. In fact, you could go the rest of your life and not add a dime to this. What would happen if you didn't lower the death benefit? You might earn 11 and net 9 because the spigot was a little bit more because you kept the death benefit and now your rate of return suffers a little bit. You earn 11 and only net 9 instead of netting 10. How do you solve that? If you don't care about death benefit, if you're 75% funded, you could lower the death benefit down to 750,000, and now it's max funded, and the cost of the insurance is Zippo or whatever from that point forward, okay? Now, you have to be careful that you don't create a MEC if you're going to use it for tax-free income, a modified endowment contract, so you have to go to an IUL professional who knows what they're doing so that you don't mess up tax-free access. But if you were doing 100 grand a year for 4 years and you're 80% funded, that would keep that policy going to age 120 and give you maybe a nice 8% payout. But if you want a 9 or 10% payout, you either lower the death benefit down to 800,000, so now it is max funded, or you simply, take less income. You earn 11 and net 9, okay? So you only take out 90,000 a year of income instead of 100,000. It's so doggone flexible. Is this making sense? So when you take out an IUL, you're not obligated to pay the planned premiums. Would it behoove you to catch up and max fund it when you can? Yeah, you could do it anytime down the road. You don't have to. If you don't, you have a choice. You're going to suffer a little bit on internal rate of return. If you tweak it and you earn 11, you might only net 8 or 9. Or you lower down the death benefit, and now it is max funded, and now you can earn 11 and net 10 because you took less insurance, and it's basically max funded with the lower death benefit. Does that make sense? So depending upon your particular set of circumstances, this is so doggone flexible. Hopefully you're seeing that based upon your health, your objectives, you can reduce down the death benefit. The trade-off is maybe a little bit lower net internal rate of return. You can solve that by just reducing down the death benefit if you don't care about the death benefit, okay? Many policies that are only funded 60 to 80% of the way, if you never lower down the death benefit, will likely last clear out to LE, life expectancy. Your life expectancy, you could still take a nice tax-free income, 6, 7, 8% payout, and still the policy would be in force until your life expectancy. If you want to make sure it stays in force till you're at age 120, then you take a little bit less income or you lower down the death benefit. Does that make sense? So hopefully you gained insights here. If you want to learn more, of course, you can read one of my books. My most recent is The Laser Fund, 300 pages of charts, graphs, explanation, and 62 actual client stories. It's a left brain, right brain book. You flip it over and you can go to laserfund.com, click on the link and contribute a nominal amount towards the shipping and handling. I'll cover the rest of that. I'll pay for the book. But if you want to learn even more about what I've just talked about, I would recommend that you watch this episode here and get another perspective about how incredible IUL is for you.